Hi everyone, and welcome to this Black Tower presentation on US expats and investing. Now, we're going to break down this presentation into several parts. And the first part is we're really going to explore why it's so hard for US individuals outside the US to invest. We're going to look at US-based investments, so those are investments you have back at home, and why it's hard to invest in your new country of residency as an expat. And then we're going to look at how you can manage those US assets you have back at home, followed by our last section, which is how you can manage non-US based assets, so those are investing in your new local country of residency. So what problems do US expats face? What we're seeing is that US banks and investment houses just don't want to deal with US expats. They're closing US expats' accounts and refusing to allow them to trade or manage those investments once they've left the US. Now, there are many reasons that they're giving as to why they're closing these accounts or why they're restricting them from trading, but the predominant ones that we see is that it tends to be a lack of US address. Now, technically speaking, these US banks can service expats, but the increased compliance and regulatory burdens means that they often just don't want to. And many expats can find their accounts restricted or even closed. Now, when your account's restricted from trading, you lose the ability to rebalance and modify your existing investments. And that's essentially tying your hands behind your back when it comes to investing, as you're unable to react to market conditions or circumstances. Now, closing your account is even worse because it stops your investments from being able to grow. And essentially it means that your investments are sold at a time not chosen by you. And unless you're extremely lucky, you're not going to have your investments sold at the time of your preference. When we look at retirement accounts, in the case of 401ks, traditional IRAs, these problems also apply. We're seeing more and more retirement account providers closing or restricting access to US expat accounts. When providers take actions against their US expat clients, the best case scenario for them is that they're restricted from trading and rebalancing their portfolio. And the worst case is that US expats are either asked to find a new custodian or see their accounts closed. Now let's have a look at the best case scenario in a little bit more detail. And to understand why having your access to your account restricted from trading is such a bad thing to happen, we first have to talk a little bit about risk. Now, what is risk when it comes to investment? Well, risk really refers to what's known as volatility of price or short to medium term unpredictability. So when we talk about an asset having high risk, that means in the short term, the price is going to be very unpredictable or very volatile. It's going to jump up and down repeatedly. Now, the other thing that we need to understand is the relationship between risk and reward. Because predictability is a benefit, unpredictable assets are often undervalued. And as such, by increasing risk or increasing unpredictability, in the long term, you as an individual investor have a much higher potential to experience high long-term growth in your portfolio. So the traditional understanding is as we increase risk or unpredictability, we increase our long-term gains, although of course nothing is guaranteed. So where does this come in with retirement planning? Well, when we are young and when we're working, all of our funds in our retirement account, we don't need those assets to be predictable in price because we're not selling them until retirement. So they can jump up and down as much as we want, and we don't mind because we're happy with that performance in the short term because we understand that in the long term, they're likely to grow far higher. However, when we get to retirement, you stop earning money and your retirement withdrawals become your new income source. In this circumstance, predictability is really important because you want to be able to have a predictable income. You want to know how much money you're going to get on a monthly basis or a yearly basis so you can plan around it. Imagining having a job where your employer randomly gives you a different amount of money every month. That would make life so much harder. So for that reason, as we get closer to retirement, we want to have more predictability in our portfolio. Not to mention that, but having highly volatile investments as we get closer to retirement runs the risk that there could be a large, sharp downturn in the market, a correction, or even, God forbid, a crash, and that could severely reduce your retirement income for the remainder of your retirement. So we always recommend that it's important when you are planning for retirement to start out with high risk investments according to your risk profile and comfortability. And as you get closer towards retirement, to then de-risk these when we need to start favouring predictability. So when a retirement plan is restricted from trading, you are losing one of the most fundamental tools in order to build a retirement. Now that's the best case scenario. Let's talk about the worst case scenario. And that's being asked to find a new custodian or having your account closed. If you are asked to find a new custodian, you are normally given a fixed amount of time to do so. And as a US expat, that's going to be very hard for you. Because for the exact same reasons your old custodians are asking you to find a new one, any new ones you approach in the US are unlikely to want you either. Failure to find a new custodian means that the funds will be paid out directly to you. And this has some serious tax consequences because that will be treated as income and you can have in excess of 45% tax penalties on that. And then on top of that, if you are under the age of 59.5 years old, you're going to have early access penalties of an additional 10% worth of tax. So the worst case scenario is that let's suppose you're an expat outside the US in pretty much any country in the world and you use the 60-day rollover rule to have your retirement accounts paid out to your bank account, whether that's in the US or locally. And while the US government might accept or will accept putting that back into a retirement account within the 60-day period shouldn't generate any tax liability for you, that is very unlikely to be the case in your local country of residency. They will just see income, and that's income they can tax. So the worst case scenario is you do find a new custodian, but you use a 60-day rollover rule to transfer it to your accounts and then into a new account. So you have to pay tax on that in your local country of residency, and then you'll still have to pay tax when you withdraw it from the US in retirement because it's in a retirement account. So it will be an income generating event when you take it out the second time. But regardless of whether you have the best case scenario when the provider takes action against you or the worst case scenario, there are additional considerations that you need to make. One, not having a US bank account when you come to retire can make withdrawing money from your retirement account a very complicated procedure. Certain retirement administrators currently refuse to pay income from a US retirement account into an international bank account. So retaining a US address with your providers in order to try and sidestep these issues by saying that you're still in the US to them can lead to significant problems. One, you are misrepresenting your country of residency to a regulated authority. Two, cash flow issues can arise because they will pay out your pension net of withholding tax, and then you will have to pay tax on those withdrawals in your local country of residency, so you're essentially paying tax twice. You will be able to claim that tax back through foreign tax credits, but it does mean that for a certain period you'll have paid too much tax and have less cash. But I think the major thing to think about is that that often is unlikely to work just because simply by filing a tax return as a US expat, which everyone is required to do, many providers are updated by the IRS as to your new country of residency. So it's not been an option for most people. Now we've covered assets in the US, let's just have a look at a quick summary of this. Having an investment account restricted from trading will really impact your ability to react to market events and manage your portfolio effectively. Having an investment account closed means that it just stops growing, and chances are it will be closed and your assets will be sold at a time you do not want it to be sold. Consider the fact that stock prices globally fell considerably in 2022, and let's suppose accounts were closed in 2022. Well, I can tell you that most of those accounts would be unhappy that they were sold at such low prices. Now, retirement accounts are probably more serious because not being able to manage risk in a retirement account, if it's restricted from trading, loses one of the most fundamentally important tools when it comes to retirement planning. Either you will be in a situation where you've got far too high risk investments as you approach retirement, and your portfolio will be very unpredictable, and you will not be able to have a predictable income. Or if that's not the case, that will mean that your retirement account has been completely far too under-risked and hasn't grown enough in the years leading up to that. And the worst option for retirement accounts is, of course, having to find a new custodian or having them closed, because that can lead to severe tax penalties if you do it wrong. But now let's have a look at non-US based investments. Now, this is probably something that most people watching are more familiar with. If any of you have tried to open a bank account outside the US, you're always asked if you're a US citizen. And in this section, I get to explain why that's the case. And the two major hurdles affecting US expats when it comes to investing are the Foreign Account Tax Compliance Act and Passive Foreign Investment Companies, or PFICs. Now let's just have a look at FATCA, or the Foreign Account Tax Compliance Act. This was enacted under the HIRE Act in 2010. It really was just created as a way of trying to target tax evasion, and all it does is it requires US citizens to file annual reports on any foreign account holdings. That doesn't really seem to be that much of an issue if you think about it, but it's had some major unintended consequences for US expats. Individually, the consequences for failing to do this are fines between $10,000 and $50,000, and it only really applies to US expats who have either $200,000 net asset value at the end of the year, or at any one point during that year having more than $300,000 worth of net asset value. However, those aren't the problems for US expats. The problems really stem from the effect it has on international banks. Now, international banks, so the local banks that you might be trying to sign up to as a US expat, are required to report all of their US connected individuals to the IRS. Now, their fines are very significant because failure to be compliant with FATCA can result in an additional 30% withholding tax on all US sourced income. And for most international banks, that is a huge figure because so many of them do significant business in the US. And the IRS reported in 2022 that over 400,000 international entities were fully compliant with FATCA. So what's the problem? Well, the problem is that there's more than one way to be compliant with FATCA. The first is to report all of your US connected individuals to the IRS and do paperwork. The second is just to not take on US clients. And that's why I'm sure most people watching will have an experience of being rejected from opening an account somewhere because they are in America. And this is the reason, because international banks don't want to put the time and effort in order to make sure that they are compliant with FATCA. Because just simply saying no to US expats is the easiest and honestly safest option to secure their profits. So the reason that you struggled so much is because of an incentive to try and stop tax evasion. But let's suppose that you are able to open an account somewhere and you are allowed to invest. Well, then the next hurdle that a lot of US expats face is falling foul of what's known as PFIC investment. A company is classified as a PFIC if 75% of its gross income is from non-business operational activities, or it has 50% of its average percentage of assets held for the production of passive income. Now, what's the problem with holding a PFIC? What this means from a tax perspective is that profits aren't taxed as capital gains. That sounds great, but no, they're taxed as income, which is far more costly and often makes it fiscally unviable to invest in PFICs. A US citizen owning a PFIC, whether they're abroad or at home, has to file an IRS form 861, Mutual funds and ETFs are all classed as PFICs because more than 50% of the assets are held for the production of passive income, as all of the assets within it are smaller companies which are being held for the purpose of passive income, regardless of whether those companies themselves are actually PFICs or not. And the other problem with PFICs is that a company cannot be a PFIC. You can have a company which isn't a PFIC, it has an investment strategy change, perhaps it buys a certain amount of assets which suddenly become more valuable, and then it can change into a PFIC without you realizing. So just getting it right when you first invest in individual companies doesn't necessarily mean you're going to avoid PFIC, or what I like to call the PFIC trap. Just to summarize this, the main reason that US expats outside the US find it so hard to invest locally is because taking them on as clients just isn't worth the risk to international banks. If they fall foul of FATCA legislation, the tax penalties are so large compared to the amount of value that a US expat client represents to them, that it's just not worth the risk. And as such, we've seen more and more of them just say no to pretty much all US expat clients. And even if you do get past that step, you can fall foul of investing in PFICs, making your investment proposition very tax inefficient, which will really hamper your long-term gains and growth potential. But it's not all bad. There are solutions for US expats. Now, if we look at the US-based assets, option one is doing nothing. And that's leaving your assets in the US invested and just hoping that you don't have your account closed or you don't have it restricted from trading. Now, option two is moving the investments across to a FATCA compliant platform in your country of residency. For this, we always recommend using advisors with US regulatory expertise, who have the relevant qualifications, to make sure that you're not going to invest in any PFICs, while also conforming to your local rules and regulations, as well as US rules and regulations. Local-only advisors will not have the knowledge of the US market in order to do this. And US advisors, firstly, normally won't accept foreign US-based clients, and will also not have the knowledge of the local rules and regulations for your country of residency. So now let's have a look at 401ks and IRAs. Again, you have the option of doing nothing, but if the provider restricts your account from trading, for all of the reasons we spoke about in the last section, that's a bad thing. That means you can't effectively manage risk in retirement, and you're either going to be too low risk while you're building wealth, or you're going to be too high risk when you're taking it out. Not only that, but you're going to struggle to withdraw the assets, or potentially struggle to withdraw the assets in retirement, as a lot of providers refuse to pay out to foreign bank accounts. And again, that's all best case scenario. The worst case scenario, remember, is that you're forced to find a new custodian anyway, or have everything paid out to you. And in this case, you're forced into an action, but you're going to have a time limit, and you're going to find it very hard, because searching for custodians which want to take your investments when your old custodian doesn't is going to be a challenging procedure, just for the same reasons that you're being asked to close the account in the first place. So, what's your other option? Well, you can find a duly qualified, authorized, registered investment advisor in both the US and your country of residency to help manage your retirement accounts. And this allows you to combine all of your existing retirement accounts, excluding your Roth retirement accounts due to tax reasons, into one easy to manage traditional retirement account. They will also help manage any Roth retirement accounts you have, but you don't want to move the two together because it would remove all of the Roth retirement accounts' tax efficiencies. They would do this through a non-taxable direct rollover, avoiding any potential tax problems that a 60-day rollover might incur. It allows more control over your investments and a greater investment choice. And not only that, it means that you'll have a much easier time ensuring that you get access to your withdrawals at retirement. Now, the problem that a lot of expats find is that there are very, very few companies that maintain licensing in multiple jurisdictions, and Black Tower Financial Management is one of those. Almost no other companies offer this service due to the high regulatory burden that is required. Not only that, but Black Tower Financial Management has entities licensed and regulated across several jurisdictions around the world. And we're one of the only advisory companies outside the US to have Series 65 licensed advisors with the fiduciary responsibility to our clients. In addition to that, we even have no initial fees for managing retirement accounts. Now, let's move on to solutions for non-US based assets, so investing in your local country of residency. Of course, you do have the option of doing nothing, but what this really means for you guys is it means that you're just letting your money sit in cash. It's no longer growing, it's losing out money to inflation every year, and you're not investing. Option 2 is you can try investing on your own. Now, that's going to be impossible for most people. It's very hard to invest with any investment provider on your own with less than $1 million. Banks and trading platforms, again, just won't onboard you because they're terrified of FATCA. And even if you get to the stage where you can, remember, there's the PFIC trap. You can invest in non-PFIC companies as well, which later become PFICs, and then suddenly you're having to pay income tax rather than capital gains tax. It can be quite unmanageable for many. Not only that, but if you're doing it all alone, that requires you to be managing your portfolio at all times. And how much is your personal time worth to you? How much effort are you required to put in to manage your own investments? Because it's not as simple as back in the US when you can buy a mutual fund or an ETF. You have to buy single stock investments or single asset investments. And then on top of that, you have to make sure that they are not PFICs. And then on top of that, you have to make sure that they stay non-PFICs because they can still become PFICs. So just with that, you are increasing the amount of effort and time that an individual has to do when it comes to personally investing tenfold. So when I was younger, before I became a financial advisor, I was a stockbroker. I have the knowledge, qualifications, track record to trade single stocks myself. But typically, I invest all of my money with funds because I value my time and effort too much. Because when I was trading single stocks or single assets, I would constantly have to keep on top of market news and information. And to be honest, that was just ruining my free time and ruining my free time with my loved ones. There's nothing worse than being an anniversary and looking at your phone because you're addicted to Bloomberg. So I prefer to have my investments managed by investment professionals who I can trust. I have to sleep, but the markets don't. By using industry professionals, they have whole teams of analysts and researchers which you can take advantage of. I can promise you that no individual is going to have the same access to information than Goldman Sachs analysts might have. None of us are going to be able to trade faster on new market events than an algorithmic trading program can. And none of us are going to have the same cost to entry when it comes to investing in these assets, because as individuals, our costs of investing are higher because we don't take advantage of economies of scale. So there is one option, which I'm by no means recommending, but it is an option which we are seeing more US individuals every year consider, and that is renouncing a US citizenship. Now, I think for most people this is out of the question, but it would mean, because you no longer are a US connected citizen, your FATCA liabilities and the problems associated with them would go away. Now, it does require having another citizen, because the last thing you want in life is to become stateless. It does involve a $2,350 fee, which in the context of things might not be that much of an issue. It is fully irrevocable. So if you say goodbye to the US, you don't get to say hello again. They do not invite you back. But the most important thing is what's known as the exit tax. Now, the exit tax applies to what's known as a covered expatriate. And this is if certain conditions are met. Any of these conditions are met, you are a covered expatriate. So your net worth exceeds more than $2 million. Your US income tax liability exceeds $162,000 for the previous 5 years. And you have failed to certify that you've complied with US federal tax obligations for the previous 5 years. So if any of those 5 areas affect you, you are a covered expatriate. And the consequence for renouncing a US citizenship as a covered expatriate is they take your total net worth, so that's all of your values, property, assets, investments, bank accounts, what have you, and tax it as capital gains tax, as if you'd sold everything at once, excluding the first $737,000. So if you're a high net worth individual, the tax bill at the end can be in the millions of dollars for doing this. However, I think the main reason that people aren't going to be looking towards this is because people don't want to announce their US citizenship for very good reasons. If you don't think you can do it alone, which I don't think most people can, or you don't want to, and you want to remain a US citizen, which I think applies to everyone, there is another way, and that's by working with US expat investment specialists to create FATCA and PFIC compliant investment strategies. It does require platforms which are FATCA compliant and able to generate the required tax reports for the IRS, but using qualified advisors, they will know the required platforms to be using. So just to summarize what your options here is you can do nothing, but you're holding everything as cash. It's really losing out to inflation and it's not investing. It's a bad option all around. Option 2 is you can try investing on your own. For the vast majority of people, this isn't an option. And for the few that can, well, they could risk tax penalties due to PFICs. They also have to give up a considerable amount of time and effort to do this, which most people aren't willing to do. You can, of course, renounce your US citizenship, but of course, most people do not want to look at that avenue. So really, if you are looking to make investments as a US expat outside the US, I strongly recommend using US expat investment specialists to create US compliant investment strategies.
Black Tower Financial Management has entities licensed and regulated across several jurisdictions around the world. And we're one of the only advisory companies outside the US to have Series 65 licensed advisors, the fiduciary responsibility to our clients.
We have a long, outstanding 35-year history with one of the best reputations in the market. When it comes to investment accounts, we do require a minimum initial investment size of $100,000. It's subject to other upfront charges depending on your country of residency. It has an ongoing management charge of 1% to manage and maintain the portfolio. And all of these accounts are fully FATCA compliant with PFIC compliant portfolios. Accounts under $1 million in value will be invested into model portfolios which conform with all of the FATCA and PFIC compliant requirements. But portfolios above the $1 million range have the ability to have a more bespoke asset selection tailored towards the individual client's needs and wants. Retirement accounts is something I think that everyone should be thinking about now if you haven't already. And I must stress that Black Tower are pretty much one of the very, very few companies able to offer this service. Again, we have a minimum investment amount of $100,000 in your retirement accounts back home. So this doesn't actually require an additional investment. It just requires that your retirement accounts in the US be totally valued at more than $100,000, which does tend to apply to most. For the management of these retirement accounts, we don't charge any initial fees. We charge an ongoing rate of 1.5% for accounts between $100,000 to $500,000. 1.25% for accounts between $500,000 and $1 million, and 1% for any account above $1 million in value. So by using Black Tower, you're able to merge all of your existing retirement accounts into one easy to manage traditional IRA, of course not including those Roth IRAs because that would be tax inefficient, but you can still manage those Roth IRAs as well. By doing this and working with Black Tower, you're able to mitigate any of the potential problems that affects US expats with retirement accounts that we discussed in section 1. So this means that you're not going to have your accounts restricted from trading. You're not going to have your accounts closed or asked to move to a new custodian. And withdrawing assets for retirement is going to be a lot smoother than potentially having to deal with retirement providers who are just unwilling to transfer funds to a foreign bank account. I have to stress once more, Black Tower are really one of the few firms within the industry which have got the level of regulatory permissions both inside and outside the US in order to provide this service. And if you're watching this video and you think that any of these points are relevant to you, I encourage you to click the link in the description in order to book a complimentary consultation with a Series 65 Black Tower advisor that has a fiduciary responsibility to your needs.